Imagine buying a stock at $50. A week later, it rises to $55. Your hands start sweating. You think, I should lock in this profit before it disappears. So you sell. A month later, that same stock is trading at $120. You made money, but you missed the life-changing move. Now imagine the opposite. You buy another stock at $50. It falls to $45. Instead of selling, you convince yourself it'll recover. You wait. $40, $35, $20. By the time you finally give up, your account has taken a devastating hit. Does this sound familiar? Most investors do exactly this. They sell their winners too early and hold on to their losers for far too long. Jesse Livermore, one of the greatest traders in history, believed this single habit separates average investors from extraordinary ones. His famous principle was simple. Let your winners run. Cut your losses quickly. It sounds obvious. Yet almost nobody follows it consistently. People spend years searching for secret indicators, perfect chart patterns, and complicated strategies. But Livermore discovered that some of the biggest fortunes in the stock market were built not by buying brilliantly, but by holding patiently. He once said something that every investor should remember. It never was my thinking that made the big money for me. It always was my sitting. Think about those words for a moment. Not my thinking, not my predictions, not my analysis, my sitting. His greatest profits didn't come from making hundreds of trades. They came from staying with the right ones long enough for them to become extraordinary. That sounds simple, but simplicity is often the hardest thing to practice. Our brains constantly push us toward the wrong decisions. The moment we make a small profit, fear enters the picture. We begin imagining everything that could go wrong. What if it drops tomorrow? What if I lose these gains? What if this is the top? So we sell. The strange part is that when we're losing money, our minds behave completely differently. Instead of fear, hope takes over. We'll recover. I'll sell once I get back to break even. It's only temporary. Days become weeks. Weeks become months. Losses grow larger. Some investors hold losing positions for years simply because admitting a mistake feels more painful than losing more money. This behavior has been studied extensively by psychologists. It's called loss aversion. Human beings experience the pain of losses much more intensely than the pleasure of gains. That's why a portfolio that's up $10,000 but falls back to $9,000 suddenly feels like a painful loss, even though you're still ahead. Our emotions don't measure absolute gains. They measure what we've recently lost. Livermore understood this decades before behavioral finance became a recognized field. He knew the market wasn't just testing intelligence, it was testing emotional discipline. History provides countless examples of why patience matters. Think about the greatest companies ever created: Apple, Amazon, Microsoft, Nvidia, Tesla. None of these companies moved upward in a straight line. Every single one experienced frightening corrections. Amazon lost more than 90% during the dot-com crash. Many investors believed the company would never recover. Apple has experienced multiple declines greater than 50%. Nvidia has suffered sharp drops several times during its incredible rise. Every correction convinced thousands of investors that the story was over. Many sold, very few stayed. But those who held through the uncertainty witnessed returns that transformed their lives. The truth is that every legendary investment looks obvious in hindsight. At the time, it rarely feels obvious. It feels uncomfortable. It feels risky. It feels uncertain. Patience always feels difficult because the future is never guaranteed. That's why so few people benefit from it. One extraordinary investment can completely change your financial future. That's something many investors fail to appreciate. Imagine two investors. The first investor sells every winning stock after making 15%. They repeat this process over and over. Small gains, quick exits, constant activity. The second investor also finds good companies. But instead of selling after 15%, they continue holding businesses that keep growing. Some investments double, some triple, a few rise 10 times. Perhaps one grows 20 times over many years. Even if this investor has fewer winning trades overall, their wealth becomes dramatically larger. Why? Because investing isn't linear, it's exponential. A stock that doubles doesn't just create more profit, it creates a larger base for future growth. Then those gains compound again, and again, and again. Compounding is often called the eighth wonder of the world, but compounding only works if you stay invested. Every time you sell too early, you interrupt the process. It's like planting a tree and digging it up every month to check whether it's growing. The tree never gets the chance to become a forest. Markets reward patience in ways that most people underestimate. Everyone dreams of finding the next great company. Very few people have the patience to stay with it once volatility arrives. Imagine buying shares of a company. The stock doubles. Financial news starts warning about overvaluation. Experts predict a correction. Friends tell you it's time to take profits. Social media fills with headlines claiming the rally's over. The price falls 15%, then 20%. Fear grows louder. Everything around you encourages selling. But if the business itself continues improving, what has really changed? Often, the only thing that changed was the stock price. Livermore understood that markets constantly test conviction. They shake out impatient investors before rewarding those who remain disciplined. This is one of the greatest paradoxes of investing. Everyone wants extraordinary returns. Very few people are willing to endure the emotional discomfort required to earn them. Patience isn't passive. It's active emotional control. It's resisting the urge to react every time prices fluctuate. It's understanding that volatility is the price investors pay for long-term wealth. Without volatility, there would be no exceptional returns. The greatest investors in history all shared one remarkable characteristic. They understood that time is often more valuable than timing. Finding an excellent business is only the beginning. Allowing years of growth to unfold is where the real wealth is created. Of course, letting winners run doesn't mean holding forever, regardless of what happens. Livermore never suggested blind loyalty. There are valid reasons to sell. If the company's fundamentals deteriorate, if management loses its competitive advantage, if the original reason for investing no longer exists, then selling becomes rational. But selling simply because you've made money is rarely a strong investment strategy. Profit itself isn't a problem. Success isn't a reason to leave. Many investors confuse making money with finishing the journey. Sometimes the biggest gains are still ahead. Markets have an interesting habit. They reward those who can ignore short-term noise while remaining focused on long-term reality. Every generation experiences new headlines, new crises, new fears. Yet history repeatedly shows that exceptional businesses continue creating value over decades. The investors who benefited most weren't necessarily the smartest people in the room. They were often the most patient. Jesse Livermore left behind many timeless lessons, but perhaps none remains more relevant today than this. The market doesn't pay investors for activity. It pays them for patience. Anyone can buy. Almost anyone can sell. Very few people can hold a great investment through fear, uncertainty, corrections, and endless negative headlines. That's why extraordinary returns remain rare. The next time one of your investments starts rising, ask yourself one simple question. Am I selling because the business has changed or because my emotions have? That single question may be worth more than any market prediction you'll ever hear. Because in the end, fortunes are rarely built by those who trade the most. They are built by those who recognize greatness, trust their research, remain disciplined, and have the patience to let their winners run. This version is optimized for AI narration with natural pauses, shorter sentences, and a smooth storytelling flow for approximately 18 to 20 minutes at a normal narration speed.